All right, let's do this. Tax tips number 7 coming at ya. In today's video, we're going to be breaking down payments on account for your self-assessed income tax. We're going to go through the age-old question of what even is a payment on account, when to pay it, and how to send the cash through to HMRC. If you want to check out our other content on self-assessment, you can click the link in the description. We've got heaps of articles and different videos that you can check out. Starting with, what is a payment on account? Well, they're advanced payments that are worked out by the government based on your previous year's income tax that you submitted through your self-assessment return. Although it can feel a little unfair because you've just shelled out for your last income tax bill, they're designed to make your future income tax bills more manageable when they come due. And it's also secretly designed for HMRC to collect their monies a little earlier and distribute it throughout the economy on stuff like the Eat Out to Help Out scheme. So when do you have to pay it? Well, you have to remember it's made in two 50-50 installments. The first 50% is due on the 31st of January, which is also when your last year's income tax bill is due. And the second 50% is due on the 31st of July. Now, if you're new to the game, prepare yourself. If this is your first year of filing, it can sometimes mean paying your full income tax from last year, as well as 50% of your next year's, meaning you can be 150% of your tax bill out of pocket. Ouch. For those more seasoned vets out there, the final concept to get your head around is what's known as a balancing payment. It's essentially the difference between everything you've paid throughout the year and what your final income tax bill is, and can sometimes mean that you end up in a refund position. How do you pay it? Well, there are some cases where you won't have to. If your self-assessment tax bill is less than £1,000, or you've already paid more than 80% of it through your tax code, then there's no need to make a payment on account. If you do need to pay it, what you'll need is your 11-character unique payment reference number, also known as a UTR, followed by the letter K. And there are 4 different ways in which you can pay this. 1, by debit or credit card. 2, by bank transfer. 3, at the bank in person. Or 4, if you're still that way inclined, by check through the post. Now, it's important to remember that you can reduce your payments on account if you think your next year's tax bill isn't going to be as high as last year's. However, it's risky, and be careful, because HMRC can slap on some interest on the amount that you've underestimated it by. A few other tips on how best to prepare yourself. Number 1, making sure you're keeping all your records up to date throughout the year, which is really easy with a platform like Ember, and make sure you have a handle on how much money you have to pay at the end of the year. Number 2, putting aside some money for those payments. Number 3, making sure that you've got your payment method set up right from the get-go. And number 4, filing those self-assessments straight after the deadline, which is super easy, again, with us for £99. Link in the description. So that's all for today, and thanks so much for tuning in. I hope you've learned something, and as usual, leave any tax-related questions you've got in the comments so that we can cover off on them in future episodes. Please like, subscribe, and share with all your friends, and we'll see you next time.